Hi, my name is Udit and I work in Germany as a finance professional. In today's video, we are going to talk about IPO investing and try to analyze is it a good investment strategy or not. Let us try to understand first what exactly is an IPO. An IPO is an initial public offering wherein a company decides to sell a part of its company to the public and raise capital. When these shares are issued in the market, the buyers subscribe to it, and then on the basis of the number of subscribers, people get allocation. Now, let us try to understand IPO investing from two perspectives. The first is the gambler's perspective, and the second is a serious investor's perspective. When we talk about gamblers perspective, we see a lot of people who invest into IPOs because they want to make quick gains at the time of listing. They want to subscribe to IPOs with the expectation that other people like them will also subscribe. It would be a lottery kind of a setup, and then since everyone is buying, there would be a very high demand. And then, as the IPO lists, people are going to be very keen to buy the stocks of that company from the secondary market, and then they will be able to make a listing gain, sell it off, and go away. Usually, this strategy is not very sound because of two factors. The first is that you are relying on luck and the greed of your fellow investors, which might not play out very well. Even if it does play out in a couple of stocks, it is very difficult to replicate this consistently. Secondly, the amount of allocation that you will get in an IPO is usually very limited and you get allocations in small bunches. What it does is that even if you make a substantial return on that amount on listing gain, it is not substantial if we talk about the absolute amount of money. Hence, it is good for entertainment and making small gains here and there, but it is not a sustainable wealth creating strategy, in my opinion. Also, since this is driven by greed and it is more like a lottery, you are better off engaging in other avenues like horse races or lotteries or casinos. It is very much like gambling and not for serious investors. Secondly, we talk about the approach that a serious investor has to take and what points he or she should consider while subscribing to an IPO. Before that, let us try and understand what exactly is an IPO and where the supply is coming from. Usually, when a company wants to raise money through equity, they decide to sell a part of the ownership of the company and raise money from the public by listing these shares in the market. When these stocks are listed in the market, the price for subscription is determined by the promoter or the owner in conjunction with their bankers. What they try and do is that they try to command the highest possible price of their stocks because their idea is to raise the highest possible amount from the public as possible. And since the owner or the promoter and their bankers know much more about the organization than any of the participants in the market, and since there has been no price discovery of this security in the market, it is very unlikely that they would be quoting a fair price. So, usually, you are getting a SAR deal at the time of IPOs. All said and done, there are also cases wherein the multiples which the promoters ask vis-a-vis what the market decides to give that stock in the short to medium term is high, but these chances are rare. And like I said, doing this continuously again and again is a very difficult exercise because these cases are also very hard to find. Since any company that is being listed would also have other companies in the similar industries which are already listed in the market and command a certain valuation. So usually it is very difficult to make money by investing in an IPO, and it is also not a very wise strategy because of information asymmetry and lack of price discovery. The lack of price discovery is obviously because the stock has not been in the market and the market participants have not agreed on the basis of their wisdom, knowledge, and forecasts on a certain price. This is a one way dictation of the price by the promoters or the owners of the company. Price discovery is a very important aspect of market which gives a certain sense of fairness to the prices of the securities which are listed in the market. Because we have multiple participants, including traders, investors, fund houses, global investors, institutions, and retail investors, everyone pools their wisdom and knowledge and an outlook about the future and decides on the prices. The efficient market hypothesis says that all the information possible is factored in the prices. Of course, there are anomalies in the prices here and there, but usually the price that a security is quoted in the market is on the basis of the collective wisdom of the market participants and not dictated by the promoters or the owners of the company. So, because of lack of price discovery and information asymmetry, you are more likely to lose money while investing in an IPO. So, in my opinion, it is not a very wise long term investment and wealth creation strategy. You can do it for fun, you can do it for engagement, but it is very unlikely that this can be a sustainable wealth building strategy. I hope through this video I was able to clarify the perspective on IPO. In case you have any feedback or any disagreements or any other ideas about this topic or any other topic regarding investing, business, or life in general, feel free to drop in comments. So with this, we come to the end of the video. I hope you liked it and I wish that we all are successful in our investment journey. And how do we become successful? By remembering the mantra that we need to keep walking and remember that growth is life. Thank you.